This is going to be an interesting one because it's a question that we often get whenever you run portfolio sessions or you have portfolio managers on stage on a panel, for example, and people ask about allocations. And we're lucky today to be joined by Scott Rundell. So he's brought to us by Copia Partners and his Mutual Limiters CIO. So he's going to look at the analysis of the challenges faced by the traditional 60-40 portfolio. So there's a lot happening. There's this simultaneous sort of drawdown between equities and bonds. So the challenge is, how can you as advisors rethink this defensive allocation that you may have, and what's the role of credit, etc., and alternative fixed income exposures. So in doing this, he's actually going to address a really common problem, and that's clients sitting in cash due to that uncertainty. So how can we circumvent that issue? How can we provide other solutions for clients? And Scott's well equipped to take us through this. For those of you who don't know, I haven't come across Scott before, Scott's got well over 25 years of financial markets experience. He's a specialist in fixed income investment strategy and particularly portfolio management, the fundamentals of credit analysis, and also relative value analysis in high yield and the investment grade space. So welcome, Scott, and thanks for recording this for us.
Thanks, Andy. Thanks for the introduction. So yeah, the 60-40 portfolio, and I'll just change the screen there. So you can see the schematic on the right there. 60-40 portfolio split is an old-fashioned, somewhat stood the test of time for many years. But through this presentation or chat, I'll go through how the traditional model works and then why the model has broken down in more recent times, predominantly after the GFC, to be honest, and I'll go through the reasons why. And then I'll present some alternatives to that cash dilemma for when people get a bit nervous and go straight to cash. Yes, it protects your capital, but it doesn't give you much in the way of income or upside through various cycles. So we'll talk about some of the strategies that you can consider in the market there, and we'll take it from there. So the 60-40 framework, very traditional, 60% of your portfolio in growth assets, i.e. equities, and then 40% in defensive assets, which has traditionally been largely government bonds. And the logic being that the equities give you long-term capital growth and so on, while the bond component gives you a defensive framework in that protects your capital during cyclical downturns, so through times when equities are weaker, perhaps because of earnings weakness or uncertainty, recession, so on and so forth, protecting your capital on the downside. And that's the relationship, the key historical relationship there is falling growth expectations in earnings, equities sell off, and then on the bond side, central banks are expected to cut cash rates, so ease monetary policy, which in turn causes bond prices to rise. The old dynamic between bonds is as yields go up, prices go down, and vice versa. When yields go down, prices go up because of the nature of how bond prices are calculated. So the result of this is you have this negative correlation between equities and bonds. One always moves in the opposing direction to the other, and as a result, portfolio diversification works. Now, with regards, just briefly on the 60-40 framework, it is a generic number. As you get through further into your life and closer to their retirement or, God forbid, your eventual demise, you would want less exposure to a more volatile asset class, which equities is traditionally is. So that 60-40 might become 50-50, 40-60, 20-80 as you get closer and closer to the end of life type scenario. Just on the right hand side, there's a couple of charts just to point to, and it shows you the top one. It shows you the rolling 3-year correlations of returns between, say, 100% 6-200, 100% bonds, and then 60-40 portfolio. And we can see as time goes by, that correlation has really turned. As I mentioned, post-GFC world, you can see 2015-16 onwards is when it really turned around. And that is more reflective, I think, of changing dynamics in the global financial markets. You've got more government intervention in markets, you have more central banks intervention. Now we have a term called quantitative easing, which came through post the GFC. It's where the central banks start to influence on yields by buying or selling government paper to add or take liquidity away from the system, and that sort of changes the interest rate dynamic. So why has it changed? What's caused it to change in the post GFC regime? So we had a period for a while of structurally low inflation from that falling interest rates. The GFC was very disruptive. We had a lot of people, or a lot of economies that were impacted by the US housing bubble and blow-on effect of Lehman Brothers and so on and so forth. So there was a very constrained risk appetite. So as a result, central banks around the world really worked hard at making debt financing cheaper by lowering interest rates, and that sort of allowed, theoretically, companies to invest for growth and so on. And that's that quantitative easing there. And on the chart in the top right-hand side, this is from 2015 onwards, you can see that the 10-year bond yield, which is the black line, was between 2 and 3% for 7 years leading into the pre-COVID period. And that's reflective of those environments I just talked about. We had low wage inflation, low inflation. If anything, I remember during that period going to presentations by the governor of the central bank saying that the RBA wanted inflation because it was just way too low. And that's the environment we had. And then we saw 2019 onwards, we had the COVID influence, which saw bond yields drop, and that was again government influence. And then came this inflation shock, and we can see that in the top chart, that sort of CPI number escalate quite aggressively up to 7% area. And that was on the back of the COVID and then the reopening of economies, basically a supply chain disruption, which is often a trigger point for where the old 60-40 formula doesn't necessarily work. And then we had a period of, okay, inflation is now under control. And then more recently, we had the oil shock with the Iran war and geopolitical issues. So that's caused another shock, which has caused, as a result, central banks to start hiking rates globally in a bid to try and contain inflation, and that's caused bond yields to rise. Bond yields, as a result, cause prices to fall. So that's caused this simultaneous drawdown problem. And I think the chart on the bottom right probably tells the best story. The grey columns are when it's 100% bonds, the purple line is ASX 200, 100%, and then a 60-40 is the blue line. Now you can see the 4 periods where I've circled with dotted grey lines showing you where bonds have behaved as I expect. Bonds have risen as equities have fallen, which has softened the diversified portfolio impact, which is that blue line. And then you can see on the far right, the red circled area where basically bonds and equities have sold off. And this is where the 60-40 model or portfolio has failed to achieve its goal of portfolio diversification benefits, i.e. rising bond yields equals falling bond prices. And then we've seen an earnings shock as a result of the oil price spike. Now, if you look at the US market, going off piste a bit here, the US market has rallied aggressively off its post-war lows, mainly on the back of technology drivers. Those stocks have risen very strongly, so softening some of the normal behaviors we see in this environment in the US market, whereas the ASX 200, our own index, has stayed softer because of, I guess, the Australian market. If you look at the ASX 200, only about 2% of that index is tech, whereas in the US, it's over 30% is tech driven. And much of the gains we've seen in the S&P 500 is tech, whereas here we don't have that. So the 60-40 model is definitely sort of failing in this environment. And on the top right-hand side there, you can see a scatter chart of the ASX 200 bonds. And you can see a sort of heavy period in 2022, especially, whereby both bonds and equities have, I should say, negative returns. So why a defensive asset class that is supposed to perform better during periods of volatility and uncertainty under-delivered in this environment? And so that's what we'll get to shortly. But first, why does it matter for portfolios, for you guys? Obviously, you have clients who are somewhat defensive. They want a balanced portfolio to protect them. Bonds are safe. And this is where there's a bit of an uncertainty. Bonds are safe in a sense that they are credit safe. There's no credit risk to a government bond. Australian government bonds are AAA rated, which is the highest rating you can have. But the behaviour through the last cycle or two has delivered returns or performance that is sort of outside the ordinary. As I've said there, loss in equities, loss in bonds, got rising living costs simultaneously. So for your average investor, that's a real concern. And as a result, many have moved to cash because it's safe. Everyone is comfortable with cash. Aussie banks are traditionally very safe. Bank failures are very rare. But in doing this, a lot of clients have missed future income opportunities. And this is where we start to bring in alternative investment. And to highlight that impact of going for cash, on the right-hand side, you can see this chart, which shows you the real cash return on the back of where the cash rate is and where the CPI is. And you can see that the returns are really quite poor. And ultimately, if you stay in cash for too long, you do go backwards. So this is where we start to look at or rethinking defensive allocations. And as I touched on a moment ago, government bonds are defensive, but they only protect you from credit risk. They don't necessarily protect you from other risks. And in this case, it's interest rate risk. So as we say, the traditional defensive exposure is a long duration government bond or an aggregate bond benchmark. The alternatives are more, I've used the term emerging defensive toolkit. The top of that list is floating rate notes, which traditionally falls under the fixed income banner. Fixed income is like the term used for, sometimes we refer to tissues as Kleenex and so on. So it's just a brand type thing. And within the fixed income universe, there is both government bonds, credit bonds, investment grade, sub-investment grade, but also floating rate notes, despite the term fixed. What floating rate notes do is they protect you from that duration risk. For those who are not overly familiar with duration, it's essentially a measure of interest rate risk. And the longer or the higher the duration of a bond, the greater the sensitivity that bond has to rising or falling interest rates. In an environment where bond yields rise, I should say, the capital price of a bond will fall. To give you some examples, in March this year, when the US and Israel attacked Iran, and we saw the massive spike in oil prices, bond yields in Australia rose about 50 basis points or 0.5%. And that caused bond prices to fall 2 to 3%, depending on their duration. For many, that would see a bit of an oxymoronic outcome. It's a defensive asset. Geopolitical risk has risen. Why is my defensive asset delivering a negative return? And that's because in this instance, the geopolitical escalation came with a supply shock, the oil price impact. In an inflationary environment, bond yields go up, and that's why we had that impact. So I've listed a bunch of alternatives there that investors can consider. Floating rate notes, I won't go through them in detail, but the main benefit of floating rate notes, and probably the most accessible in the Australian market and the deepest, I would say, of those categories there, except perhaps the investment grade credit sector, but they offer lower duration risk. So for example, a floating rate note in the bank space, for example, and the banks are the largest issuers of floating rate notes, the duration is only 0.25 a year, because every 90 days, the coupon on a floating rate note resets at a fixed margin. So for example, if a bank issues a 5-year floating rate note at 100 basis points over the bank bill swap rate, every 90 days, the coupon on that bond, on that note, resets at 100 basis points over the prevailing bank bill swap rate. Now, in an environment where the RBA is increasing interest rates, that has traditionally meant that the coupon gets higher and higher. So, for example, with the RBA hiking interest rates 0.75% or 75 basis points year to date, typically the coupons on floating rate notes have risen by 75 basis points over that period to reflect that change. So that means there's less capital volatility in a floating rate note. Investment grade credit is traditionally still a fixed rate environment, but it does give you a credit spread over sort of govvie bonds. So that gives you a little bit more credit enhancement. And the other one's short duration credit. So that's basically something that has less than 12 months to run. The bottom three, private credit, there's been a lot of media coverage on private credit, most of it tending to be negative in tone. And there's a lot of instances in the US where private credit firms or private credit funds have had drawdowns, and some of those funds have had to lock up to avoid sort of a panic sell. The market here is still reasonably youngish. It's a fine asset class, but investors just need to be wary of the liquidity dynamics of those funds. Many only have monthly redemption windows, whereas a lot of floating rate note funds, such as our own, have daily redemption windows. Inflation-linked bonds, it's a pretty small market. There's only about 5 bonds available, and they're all government issued, so liquidity is a bit different, and obviously only accessible to wholesale investors. So the key shift is sort of what defensive assets are to what risks are we defending against. And I've touched on that main differences, but there's credit risk, which is what the govies protect you against, but then there is interest rate risk, which govies do not protect you against, but floating rate notes do. So duration risk, some found retail investors often get eyes roll in the back of their head. They try and figure out duration risk, but as I've mentioned earlier, it's a measure of sensitivity to interest rate changes. So if you look at the various types of fixed income or interest rate type products, cash has 0 duration because it's just a flat rate. There's no duration. Floating rate notes, as I mentioned, very low, and as a result has low sensitivity. On the right-hand top side, there is just a sort of definite or a schematic of how it all works. The longer the duration, the greater the sensitivity. And then on the bottom right-hand side there, you can see the FRN and the fixed rate credit indices. So there's 2 indices in the market. The grey dotted line is the FRN index, and then the red one is the fixed index. As you can see, the red one has a lot more volatility to it, and that's that duration risk that I mentioned. And as you can see, the floating rate has never really delivered a negative return. I think it's only done it once or twice, but very small. Whereas through time, there's been more chances of the fixed rate index delivering you a negative 12-month return. On a monthly basis, the FRN index has delivered, I think, a positive return about 95+% of the time, whereas the fixed rate index has delivered a positive monthly return sort of 79% of the time. So depending on what your appetite or your client's appetite is towards capital downside, then perhaps floaters are something to consider. So there's those numbers there, 95 and 79. The floating rate market is a mature market. It's a deep market. The most active issuers in that space are banks. So the major banks, the regional banks, and in some instances, offshore banks, typically big, large global banks. There's about 250 billion, 300 billion of outstanding paper in the market, and it trades regularly on a daily basis. And importantly, through the last couple of months when it's been very volatile, trading conditions have been pretty solid. We've been able to sell and buy bonds as we wish with no real constraint. And the only times there has been real constraints in that market, along with other fixed income markets has been during the COVID period, especially when that time when we learned that everyone was being locked up and had to work from home. That caused a lot of volatility in the markets. So to give you some context, in March 2020, so we went into lockdown, the ASX 200 lost almost 40%, whereas the FRN market lost about 2%. So it performed its role, and importantly, we were able to trade quite comfortably during that period, especially bank FRNs. So a little bit more about floating rate notes. As I mentioned earlier, the coupons are reset periodically and incomes rise, and when the RBA changes the cash rate, because it in turn influences the bank bill swap rate. With regards to the underlying issuers, so there's the FRN index, which I mentioned earlier. About 80-85% of that is major bank issuance, so AA minus rated. So Australian major banks are some of the highest rated banks in the world and have a very good and strong track record of underlying strength, capital, asset quality, liquidity, and so on and so forth. And the major banks do enjoy a degree of implied government support, which is evidenced through both the GFC and the pandemic, when the government, through the RBA, Reserve Bank of Australia, provided cheap funding for the banks to ensure they continue to operate without constraint, which was again another sign of support for these Aussie banks. On the right top hand side of this page, on the bottom axis is the prevailing yield, and on the y-axis is the risk or standard deviation of month-on-month returns. And you can see that the ASX 200, the current yield, which is the dividend yield I've used, its volatility is quite high relative to, say, cash, FRNs and fixed. And you can see that the FRN index is a less risky asset class or product than, say, fixed rate bonds, and then you've got cash at the bottom, which it should be zero, but that's just using the bank bill swap rate as the measure in this case, but it should be zero. So as I mentioned, moving on from cash, what are some of the focuses that you can look at? I guess the pitch that we would use to clients is that you don't necessarily need to move from cash directly back into long duration bonds. There are alternatives, and in this case, FRNs are an alternative. There's some data on the top right hand side there showing where the current prevailing yields are. The FRNs, again, 5.3% yield, or a fixed rate if you're inclined at 5.5, but the fixed rate will have higher volatility because it's linked to underlying bond rates. FRNs trade regularly and through secondary markets without really any constraint. They offer a very good defensive component to a portfolio. Again, looking at your client's risk appetite. While there may be some clients who want to take the risk of duration because they like the upside, and when it is performing well to the upside, then that's great, but it also does introduce a lot more downside volatility. And as I mentioned in March, we saw the fixed rate bond indices sort of lose 1%, 2%, 3% depending on their duration, whereas the floating rate index stayed positive. So it really comes down to your client's defensive mindset, or lack thereof, or alternative, I should say. The vast majority of FRNs or floating rate notes in the market are investment grade, issued by the banks, as I mentioned. There's also the growing need for banks, especially in Australia, to issue what we call subordinated bonds or subordinated floating rate notes, or AKA Tier 2, for those investors who have been active investors in bank hybrids. If you follow the media around these products, the bank regulator has deemed that hybrids are no longer fit for purpose. And as some background as to why, we do get asked this question. Last year or so, there was a bank, Credit Suisse, one of the oldest banks in the world, failed for various reasons. I won't go into the details. But in the wash up of all that, the Credit Suisse hybrids were wiped out. Investors received zero, but equity holders in Credit Suisse were left whole, albeit at a deep discount to what their previous price was. That sort of goes against the grain of what normally happens in an environment. Hybrids rank above equities, and those equity holders should be wiped out before hybrid investors are impacted. Didn't happen in the case of Credit Suisse. So it created a bit of a negative risk connotation for local investors. And the hybrid market in Australia is quite unique to the rest of the world, in the sense that the hybrid market here was, and still is for the moment, a retail market, whereas the hybrid market in offshore jurisdictions such as the US, Europe and UK is very much a wholesale only market. Retail investors are not permitted in that space. So APRA, the bank regulator, was concerned that a moral hazard might be presented, causing the banks to support equity holders but not hybrid holders. The regulators deemed appropriate is that these hybrids, some sort of $45 billion worth, is to be replaced by Tier 2 or subordinated bonds. So we'll see more issuance of Tier 2 bonds in the Australian market and offshore as well. Slight deviation there from theme. But on the right-hand side, bottom, you can see the chart of running yield on FRNs versus cash and the spread. So it just shows you a reasonably consistent spread above cash for FRNs, which for investors does provide good capital preservation, but it's also a better income play for investors, especially those who rely on the income, say those in retirement years. They got a good and steady income stream from their investments. Credit's not a dirty word. There are various degrees of credit. There's obviously investment grade, there's high yield. On the top right-hand side there, you can see the chart. I'm using US data here because the Australian high yield market doesn't really exist in the same sense that it does in the US, but the behaviors here would be similar to what you'd expect. And we can see during the COVID outbreak that we saw investment grade spreads go from 1 to 300 roughly, whereas in the high yield space, I went from 400 to 1100. So a much more violent reaction, but you also see the recovery as well as governments around the world stepped in to support their economies. And then the last sort of big flare up, if I could call it that, was last April when Trump introduced his reciprocal tariffs, caused a lot of uncertainty. We saw spreads punch wider. For some comparison, I haven't charted it here, but if you look at Australian credit spreads, investment grade spreads, we are typically less volatile than US spreads in the investment grade space, and we tend to outperform in periods of volatility. So in this case, if I look to the COVID period where the US investment grade market went from say 100 to say 350, in our market, the move was a lot less aggressive, mainly because of just the stability of our investment grade market and an increasingly and almost structural demand for paper, given there are some supply constraints occasionally. So the benefits of investment grade credit, it gives you a higher running yield, moderate volatility, and diversified income. The spread widening is the main risk. And again, that tends to be one issue where it does present itself is during periods of market dislocation. And sometimes we get liquidity stress during periods of uncertainty. But again, if you look at the difference between corporate credit, so credit issued by the likes of Telstra or Wesfarmers, versus credit issued by the banks, typically perform much better during periods of market dislocation because the banks themselves will support their own paper, whereas they might be blocked from investing in corporate paper that's not their own, just because their internal risk committees don't want to be involved in that space until things are a bit clearer. So from an investor's perspective, the objective is not about eliminating volatility, but just to sort of provide an improved risk-adjusted portfolio resilience. Again, taking some of the rough edges off during periods of heightened volatility. So as I mentioned earlier, the old model, very much government bond dominated. Moving forward, there's a more blended alternative with various scenarios there. So it gives you greater flexibility during various inflation regimes. And inflation is over the weekend. There was hopes that perhaps the peace deal will come through. We've seen oil prices this morning are off 5%, back below 100. So still well above where they were pre the war, but they remain a bit of a headline risk for inflation. And while inflation remains above the RBA's target of roughly 2.5%, there is risk that interest rates will remain elevated and higher. But we can see through this table here, periods where we've had an inflation shock, how equity has performed, P1, P2, P3, so different periods through time. And only one of those saw a recession, which was, so I shouldn't say June 30, I should say June 20 at the top there, my apologies. We saw equities down during that period where inflation was elevated, but we saw better performance in other asset classes, and there much more consistent performance in FRNs, all positive, whereas in the fixed rate sector there we saw P2 6.93% down during that inflation period of the March 21 to December 22. So different performances through different regimes. And there's another consideration that I often talk to is the nature of the global financial plumbing has changed after the GFC. And I mentioned earlier, a lot more government and a lot more central bank involvement in markets, rightly or wrongly, which is in some instances softening the cycles, making them less severe, but there are unintended consequences down the line which investors need to be wary of. So the risk going forward, again, things you need to be mindful of, inflation persistence. While oil prices have obviously had a near immediate impact on cost of living and inflation, that sort of thing, they won't necessarily go away anytime soon. So if we assume a peace deal is agreed to tonight, for example, it'll take a period of time for the Straits of Hormuz to reopen and the oil prices to come back to pre-war levels, which was around $65 a barrel. It's still $95 a barrel, so still well above levels that we saw previously, and also obviously changing risk dynamics geopolitically adds a premium that needs to be attached. Credit deterioration, recession risk, obviously cost of living pressure, higher interest rates, higher fuel costs does impact household budgets such that they are spending less on discretionary products and services, which has a flow-on effect to the rest of the economy. So we've already seen forecast slowing of growth, which I expect will happen. Mortgage arrears will likely increase, but I think still remain within tolerances. And then there we have the default cycle concerns, which is probably more from a credit market perspective. It's more a US-centric concern, less so Australian market, because the bulk of bonds on issuance in the Australian market are what we call investment grade. They have a much lower default probability. Liquidity risk, again, in alternative credit markets, I've touched on briefly, private credit doesn't necessarily have the same liquidity dynamics as traded credit, so that's something to be mindful of. And again, there's that policy uncertainty. We have the central banks of the world, the RBA at least, tackling both softening labour markets, but at the same time also inflation remaining well above their target levels. It's not just about price of oil, it's also productivity concerns, and also there's a lot of government intervention. The government workforce at the moment is, I think, roughly 29% of the workforce, which is the highest it's been outside of wartime periods, and there is some who believe that's crowding out private sector and causing some sort of productivity issues, particularly in the service industry. So some of the discussions for investors or from an advisor's perspective, if you look at the defensive options there, floating rate notes, so on and so forth, it just gives you a product that you can stay invested without sacrificing income, but still protecting your capital downside. And it just gives you a little bit more comfort during periods of volatility. You can still continue to earn decent income without sacrificing that in the sake of capital preservation. So again, an area of interest for investors. So final takeaways, I guess bond diversification is less reliable during inflation shocks, and I think for the foreseeable future we're going to be more susceptible to these than in the past. Obviously the geopolitical situation has changed quite considerably over the last 12 months, 24 months, which has a flow-on effect, not just oil but also US tariffs. Certainly changed the trading dynamics. Again, a degree of uncertainty which should imply a premium to risk returns. But also defensive allocations. It's not just about bonds or government bonds. Investors should really consider alternatives as well. And again, FRNs is issued by banks. It's a regulated sector. The Australian banking system has performed very well through many cycles. The GFC especially, all the banks stayed profitable, I should say. Yes, they received government support, but that's one of their key strengths, is they are so systemic. The big four major banks are very systemically important, and as a result the government needs them operating and continuing to do what they do without any fear of failure. And floating rate notes, a bit unknown in some circles, but very much a key consideration that I would support for advisors in their conversations with clients. If I may, just a bit of spruiking of our business. At Mutual, we have about $4.8 billion under management. About $3 billion of that is across 4 funds that are listed there. The top one is a term deposit fund. So instead of having to roll your TDs every 90 days, we sort of give you a 90-day type return, but give you daily liquidity. We have an income fund, next one down, invests only in bank paper. These running yields are as at the end of April, but they're all about 20 odd basis points higher now because of rate hikes and the like. So the income fund only invests in major Australian banks. The credit fund, that offers or targets 220 basis points over the bank bill index. As you can see there, returning or yielding 6.5. And then lastly, our high yield fund, the yields on that are in the mid 8% range, targeting 4.5% over the bank bill index. Again, all these funds are floating rate notes, so we don't have any duration of any significance in these funds, and these funds are available across these various platforms. The firm is staff owned. I'm a shareholder, but the 2 founders are still with the business and running it, and we have been in business since 2010. In addition to our 4 retail funds, we have some 13 individual mandate clients that account for about 1.8 billion. As I said, all up 4.8 billion, I should say, in Melbourne based. So Andy, if there's any questions.
Yeah. Would you be able to go back to slide 12? So what the old model was this. So the blended allocations include all of these elements. In putting this together in an advisor saying, I do want to have this blend of defensive allocations, if you go back to your slide with your funds on it.
Okay, I think going across these funds, starting at the top, working your way down, the top one is the least aggressive because it's term deposits. The income fund, the next one down, that invests, the way we like to look at it is all about the spending profile of the investor. So if the investor has, let's say they're a retiree, they want to put aside their next 6 months pension payments, they would use the term deposit fund because there's no volatility. If it's a spending pattern that's say 6 months to 12 months, then there's the income fund. And the credit fund is 18 months to 24 months being the credit fund. And then the high yield fund's probably 2 years and above. Most of these funds, the term deposit funds never had a negative day because it's deposits. The other 3 funds have generated positive monthly returns at least 90% of the time since their inception. Now, the income fund was launched in 2011. And as I said, it's had, I think it was 92% positive return on a monthly basis. And the periods where it has had a negative return was during COVID primarily. So just for some context, the income fund returned a negative 2.1% in March 2020, but all our funds pay a quarterly distribution. And so March was, okay, we had a negative month, 2.1% down, but the next month we paid a full distribution. And then within 3 months, that sort of 2.1 had been clawed back and investors would have been back to square. The credit fund offers a little bit more juice, if I could use that term. They're targeting 220 over. So those 2 funds, and if you look at them together, they are somewhat correlated because they're all invested in credit. They're all invested in floating rate notes. It's just that as you go down the spectrum, the risk profile of what we invest in increases. For example, the income fund is only bank issued FRN, whereas the credit fund includes bank issued but also insurance company issued bonds, so the likes of IAG and QBE, but also invests in residential mortgage-backed securities and also those few corporates that do issue floating rate notes. And then so about 60% of the credit fund holds paper issued by APRA regulated entities, so banks and insurers, so still very low risk. And then the last one, the high yield fund, is 65% in what we call structured credit or RMBS and /ABS. So a little bit more esoteric type risks in the sense that we invest in double B, single B rated RMBS structures. Now, importantly, for the listeners who understand RMBS, the Australian RMBS market has never had a situation where a rated RMBS tranche has defaulted. Unlike the US market, we have a very, very good track record in this market since the late 90s of RMBS always performing in a sense that there's been no defaults. The strength of the underlying Australian market in housing, mortgage strength or mortgage full recourse, tax regime, and the recent budget I don't think will materially change that. And S&P have formalised that by saying they expect no ratings impact on RMBS. So I guess, from an investor's perspective, which one to look at, it comes down to your investment appetite and when you need the money or when you need to spend the money. But our strongest growing fund has been the high yield fund. We've added 300 million in the last 12 months, active in the market, and our most favoured fund, if I could use that terminology, just in a growth sense. For context, again, March 2020, that fund only lost 2.5%. Whereas the equity market was down 40%.
Hey, that's a great summary because I think everyone's going, okay, what do I do next? That is a fantastic summary of positioning that people can have in the conversations around that.
Yeah, I think when you look at these 4 funds in the context of FRN, the traded, the liquid market, the income fund, the second one down is the most representative of the market. And I would be confident to say there's not a lot of funds out there that are similar in the sense that we only invest in bank paper. Now, a lot of investors know a term deposit, they know an equity for the banks, but they don't understand the middle of the bank's capital stack. So the banks do fund themselves with bonds, and that's the senior and subordinated part of the bank's capital stack. So that's where we tap into, and we're of the view that the banks are a supported entity, rightly or wrongly, and that they'll always be protected given how important they are to the Australian economy.
Hey, you probably touched on something there because, okay, the benefits of the FRNs, you've got interest rate risk protection, so less sensitive, the higher yield and the diversity. With the risk, you've probably covered this, but I just wanted to get more solidification around this. Credit risk, I think you've already covered that off. Maybe they're not as sensitive to interest rates, but they're still subject to interest rate risk. How do you mitigate those? Is it because of the quality of what you're purchasing?
Yeah, pretty much. If you look at banks, I've used this term, if the Australian major banks were in difficulty of defaulting, then it'd be the least of our worries. We'd be living in caves somewhere because the banks and any corporate bond would be worth peanuts. As I said, major banks, AA- rated. There is a degree of government support factored into that pricing. It's implied. Evidence would suggest that it's a real and almost explicit. And in periods of heightened market volatility, and I'll use COVID as an example, we were able to trade in and out of that fund. That fund was as high as 1.1 billion leading into COVID. We were setting up the credit fund, the next one down, pretty much the day that the economy was shut down. And we seeded that fund with $300 million from the income fund, so 300 million out into the credit fund. But we also had 300 million of redemptions because the equity market had fallen 30 to 40%. So we had people do reallocations. When the equity market corrects that much, all of a sudden they're underweight equities, so they reallocate. And we were able to meet those redemptions in March and April without any major hiccups. As I mentioned, the return in March 2020 was negative 2.1. April 2020, the next month, we were up 74 basis points, and we were able to meet redemptions without any major problems. The reason being, as I touched on earlier, during periods of market dislocation, having worked in dealing rooms in the past, I know that the risk committees or the risk teams would have told the traders, you're not allowed to trade anymore because we don't know what's happening. So your lines are cut off, your books are frozen, but where they were allowed to trade was in their own paper. So just pulling a bank out of my head, NAB, their trading team were restricted from buying Telstra bonds, Wesfarmers bonds, whatever, but they could trade their own bonds. And during the height of that period, a Telstra bond, for example, the bid-offer spread would have been 100 basis points. So if you wanted to trade that, it would have cost you up to a 5% haircut on your capital value, whereas the bid-offer spread on a major bank paper was 5 or 10 basis points. So the impact was much less. So these funds, yes, credit spreads move wider, but we can still trade them. And much of the spread widening is driven more by systemic events than anything else, just because of the underlying strength of the fundamentals.
Thank you. That's a fantastic insight into that, Scott. So just want to say thank you to yourself for doing that. I think that was a fantastic walkthrough about why and the conversations to have and how to have the conversations with clients.